Something happened recently that the entire crypto world felt, but only the XRP Army truly understood. Out of nowhere, 21 Shares, one of the most aggressive and successful digital asset ETF issuers on the planet, published a bold, confident message that instantly ignited the community. XRP Army, get ready. No vague hints, no cryptic emojis, just a direct alert that something was coming. And when a company that manages billions in digital asset products sends a signal like that publicly, it isn't a marketing stunt. It's preparation, it's coordination, it's a message that major moves have already been set in motion behind closed doors. Today, we're breaking down how 21 Shares and Grayscale positioned themselves at the front of the XRP ETF race, why these filings and signals are happening now, how this affects institutional money, and why the XRP Army believes 2026 could be the beginning of XRP's most important phase yet. The ETF race that quietly began in late 2025. By November 2025, institutional interest had already started shifting after Ripple's RLUSD stablecoin pilot with MasterCard proved that the XRP Ledger was capable of handling enterprise-scale settlement. Liquidity corridors were reopening, large firms were reevaluating XRP's role in global settlement, and ETF issuers took notice. Around that time, whispers leaked that several major asset managers were quietly modeling XRP fund structures, but no one expected two giants, 21 Shares and Grayscale, to step into the arena this aggressively. And what followed over the next months was a rapid escalation of filings, legal reviews, product refinements, and strategic positioning that set the stage for a confrontation between two of the biggest names in crypto asset management. And as these developments unfolded, the community realized that this wasn't happening by accident. It was coordinated, it was calculated, and it was only the beginning.
Why 21 Shares moved first and fired the first shot? When it comes to crypto ETFs, 21 Shares has earned a reputation for moving fast and decisively. They launched one of the world's first Bitcoin ETPs, pushed out Ethereum products before most competitors even reacted, and consistently stayed ahead of regulatory developments in Europe and the US. So when 21 Shares signaled interest in XRP, it wasn't surprising, but the boldness of their messaging was. Their internal research reportedly showed increasing institutional demand for utility-driven assets, especially those tied to real payment infrastructure, not just speculative hype cycles. The XRP Ledger, active since 2012, with consistent settlement performance and global recognition, fit perfectly into that narrative. Rumor has it that their initial XRP ETF modeling began as early as 2025, driven by inflow projections showing that XRP could capture a portion of the same demand that pushed Solana ETFs to billions. Combined with Ripple's expanding institutional partnerships and the regulatory clarity forming around XRP, 21 Shares saw an opening. Their Q1 2026 timing wasn't random. It aligned with broader market cycles and anticipated regulatory windows. And then came the post, the public XRP Army Get Ready warning, telling the world that the countdown had already begun. But the biggest surprise wasn't 21 Shares at all. It was their strongest competitor. Grayscale's return to XRP after years of silence. For years, Grayscale avoided XRP completely. After removing it from their digital large-cap fund in early 2021 due to legal uncertainty, most investors assumed Grayscale would never touch XRP again. But regulatory developments changed everything. By late 2025, Ripple strengthened legal position and improved clarity around the classification of XRP, gave Grayscale the opening they needed to reconsider. Their analysts reportedly identified XRP as structurally undervalued relative to utility, and the company saw an opportunity to re-enter a market segment they had avoided for half a decade. But Grayscale's move wasn't just about re-adopting XRP, it was about competing directly with 21 Shares. Both companies dominate different regions of the crypto ETF market, and both saw 2026 as a turning point for institutional adoption. With the US, Europe, and Asia creating clearer regulatory pathways for utility-based digital asset products, Grayscale believed it could step back into the XRP market with a product tailored for institutions that had been waiting years for regulated exposure. Their ETF model reportedly included long-horizon projections tied to XRPL growth, liquidity expansion, and increasing stablecoin movement across Ripple's ecosystem. As these two giants geared up for the clash, the real story began unfolding behind the scenes, where institutions were preparing for something bigger than just ETFs. The institutional demand building beneath the surface. For over a decade, institutions have watched XRP from a distance, but 2025 changed that completely. The combination of regulatory clarity, enterprise adoption, and large-scale pilots, like the RLUSD settlement test with MasterCard, reframed XRP from a speculative token to a potential settlement layer asset. Hedge funds, pension managers, and private investment firms began looking for regulated exposure that didn't require direct token custody. ETF structures became the perfect on-ramp.
Data circulating among analysts projected multi-billion-dollar inflows into XRP ETFs over their first 12 to 18 months. Demand wasn't just from US investors. Markets in Switzerland, Germany, Singapore, and Dubai expressed interest in early allocations. Institutions were drawn to XRP's characteristics: low settlement times, predictable transaction behavior, high liquidity, and deep integration potential with stablecoins and cross-border systems. It wasn't hype, it was infrastructure. And asset managers like 21 Shares and Grayscale knew it. The ETF positioning was only the public part. The bigger moves were happening out of sight.
Why the XRP Army should pay attention right now. The XRP community has weathered more uncertainty than almost any other crypto group, but 2026 is shaping up to be the year everything shifts. Between two major ETF issuers launching competing XRP products, rising institutional interest, renewed corridor activity, and growing speculation around XRPL-based stablecoins, the pieces are finally aligning. Even retail investors outside the XRP Army are starting to recognize the significance of these developments. And if you want to stay ahead of every twist and every new filing, not hours later, but the moment these stories break, make sure you're subscribed, because as soon as 21 Shares or Grayscale make their next move, the reaction across the crypto world is going to be immediate, and you won't want to miss what happens next. But the ETF hype isn't without resistance, and the controversies behind these products tell an even more interesting story. The pushback, the doubts, and the controversies surrounding XRP ETFs. Every major move in crypto comes with resistance, and XRP ETFs are no exception. Some analysts argue that XRP's liquidity structure could make ETF management more complex than mainstream assets like Bitcoin or Ethereum. Others question whether XRPL's throughput can efficiently support the kind of institutional volume these ETFs might eventually drive. Critics also claim that XRP's global regulatory landscape remains unpredictable, even with its recent progress. Additionally, the political environment around crypto ETFs is still volatile. Some regulators want broader oversight over utility-based digital assets, which creates ongoing uncertainty. Behind the scenes, competing ETF issuers have also expressed concern about the strategic advantage XRP ETFs might bring to firms that enter early. If these products succeed, it could shift investor capital away from other digital assets that have dominated ETF markets for years. Despite the warnings, the momentum hasn't slowed. In fact, the controversy has made the ETFs even more talked about. And the final section explains why this moment could reshape XRP's role far beyond price speculation. Why these ETFs could redefine XRP's global utility. The arrival of both 21 Shares and Grayscale into the XRP ETF scene sends a message the entire industry can't ignore. XRP is no longer viewed as a fringe asset. It's being treated as a legitimate institutional product. These ETFs don't just bring attention. They bring liquidity, credibility, and long-term capital. They validate XRP's relevance in the new digital settlement economy forming across global markets. Experts believe ETF inflows could stimulate deeper on-chain liquidity, strengthen stablecoin corridors like RLUSD, and accelerate adoption for enterprise-grade payment systems. The key dates, Q1 and Q2 2026, have already been marked by analysts as the period where institutional inflows, regulatory approvals, and product updates converge. And with two major issuers competing head-to-head, the pressure on the broader financial system to respond becomes unavoidable. This moment isn't just about two ETFs. It's about a shift in how global markets recognize utility-driven networks, and XRP is sitting at the front of that shift. A new chapter for XRP is beginning. When 21 Shares posted XRP Army Get Ready, it wasn't a joke. It was a signal that the long-anticipated transformation around XRP had finally begun. With both 21 Shares and Grayscale preparing their ETF strategies, institutional demand growing, and new liquidity corridors emerging across 2025 and 2026, XRP is stepping into a spotlight it hasn't seen in years. These ETFs mark the beginning of a new narrative, one where XRP isn't defined by speculation, but by global influence, real adoption, and institutional commitment.